What if the next financial shock doesn't come from housing or crypto, but from artificial intelligence? U.S. bank stocks just recorded their biggest one-day drop since the tariff turmoil last April. And this time, the trigger isn't politics alone. It's private credit, it's AI disruption fears, and it's a growing anxiety that the financial system may be more exposed than investors realized. Today, we break down what really happened, why major banks fell sharply, and whether this is just a correction or the beginning of something bigger. The KBW Bank Index, which tracks major U.S. lenders, fell nearly 5% in a single day, its worst decline since tariff-driven volatility rattled markets under Donald Trump. Major names were hit hard. Goldman Sachs dropped 7.5%, Wells Fargo, and Morgan Stanley fell around 6%. Jefferies plunged over 9%, but it wasn't just banks. Private capital giants also saw sharp declines. Apollo Global Management, KKR, Blackstone, Ares Management, Blue Owl Capital. This wasn't random selling. This was fear spreading across the financial ecosystem. To understand this sell-off, you need to understand private credit. Private credit is lending that happens outside traditional banks. Instead of going to a bank for a loan, companies borrow from private investment firms. Over the past decade, private credit exploded into a multi-trillion-dollar market. Why? Because banks faced tighter regulation after 2008. Private firms stepped in to fill the gap. Investors loved the higher yields, but here's the problem. Many of these loans went to software companies, tech startups, growth-focused firms, highly leveraged businesses, and now investors are asking a dangerous question. What happens if these companies struggle? Artificial intelligence is transforming industries at incredible speed, but disruption cuts both ways. AI could reduce demand for certain software services, replace existing business models, pressure margins, trigger layoffs, and spending cuts. If enterprise clients cut spending, software revenues fall. If revenues fall, debt becomes harder to service. And if companies can't repay loans, private credit funds take losses. Now remember, many private capital firms both lend to these companies and own equity stakes in them. That's double exposure. And banks. Banks provide financing, underwriting, advisory services, credit lines to these firms. So even if banks aren't directly holding the riskiest loans, they're still connected. That connection is what markets are suddenly pricing in. Here's how contagion works. AI disrupts revenue in parts of the tech sector. Software companies struggle. Private credit loans become riskier. Alternative asset managers face potential write-downs. Banks exposed to the ecosystem see earnings pressure. Investors sell financial stocks preemptively. Markets don't wait for defaults. They move on expectations. And when uncertainty rises, financial stocks are usually the first to fall. Important question. Is this 2008? Major U.S. banks today are better capitalized, more regulated. Stress tested annually. This sell-off looks more like a risk repricing event, not systemic collapse. But it does signal something important. Markets are becoming nervous about credit quality valuations in private markets. AI's economic side effects, slowing deal activity, and financial stocks are extremely sensitive to those concerns. Here's what investors will monitor: rising default rates and private credit earnings guidance from major banks, AI-driven cost cuts across tech firms, private equity deal flow, credit spreads widening if private credit stabilizes. This may fade quickly if defaults rise. Pressure could continue. This isn't panic, it's caution. And in markets, caution spreads fast. The real story isn't just that bank stocks fell. The real story is this: artificial intelligence isn't just disrupting jobs in tech companies. It may be quietly reshaping credit markets. And when credit markets shift, the entire financial system feels it. If you found this breakdown valuable, subscribe for deeper global economy analysis. Because the next market shock rarely comes from where everyone is looking.